Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500, and I want to specifically talk about the head and shoulder pattern that we have on the S&P 500 here concerning a lot of investors. This is really what's driving a lot of the narrative that's talking about a massive crash, a massive collapse of the market in the short term here. And by the way, let's zoom out and be completely objective about this. We had the exact same topping pattern back in 2007. So let's discuss that. Let's discuss and try and dig underneath the surface, take a look at a few charts that are going to help us identify whether we're about to see a breakdown similar to what happened here in this week in January 2008. And that could really be the make or break event. If we break down below this pattern here, it starts to look really, really ugly for the market. That's why you come to this channel and watch these videos, to understand this crazy market and learn how to objectively take a look at what's going on. If you're interested in following these crazy markets with us, make sure to smash that subscribe button. And now, without further ado, let's get right into it. I want to start off by taking a look at this advisor and investor model. Now, this is a sentiment indicator that takes into account a variety of different surveys and different models to give a measure of the current investor sentiment. So you can see it goes up and down. It's very low when sentiment is very bearish, and it's very high when sentiment is very optimistic. Now, you can see there's a lot of information here and you can't really read it properly. So we're going to put a moving average on this chart to smoothen it out. And I've chosen the 20-period moving average because it gives very, very interesting results and very powerful signals. You can see here, well, let's go back to 1984 here. This bottom, you have big bearish sentiment reading at the market bottom. The same thing here goes for 1990, big bearish sentiment at the bottom of the 1990 bear market. Again, going to 1998, bearish sentiment right before the last leg of that massive bull run that we had. Again, at the bottom of 2003, you had two separate readings in 2008 that we're going to come back to in just a second. At the bottom of the European banking crisis flash crash. Then again, in these various bottoms, you had big bearish sentiment readings. But let's focus on that 2008 reading. Let's zoom in here a little bit and see and compare today's sentiment as we test that neckline of this head and shoulder topping pattern to the same moment in 2008, in January 2008, where the market was testing that neckline of this head and shoulder topping pattern. So first of all, let's zoom in to 2008 and see where we were at in January 2008. This is where we were. And you can see this indicator was actually pretty elevated. It was around 0.4. If we compare that to where we currently are at that same technical posture, we're very, very low. We're at around 0.2. So a lot more fear in this market. And that means there's a lot more buying power. A lot of people that are sitting on the sidelines waiting to get back into the market. If we zoom out on this chart, this reading that we have right now looks a lot more like the reading that we had around in March 2008. And that was right here at the bottom of this move down, right before that big bull trap in 2008. So, you can be bearish on the market. You can think that we're currently in a bear market. That's very possible. But that doesn't change the fact that sentiment is very, very overextended. The market is very overextended. And that just by looking at this, it doesn't look like we're in the same type of situation as January 2008. Now, another chart I want to show you to compare those two moments in history is in this article that we posted last week. Right towards the end of this article, we talked about this chart here, the Dow Theory Divergence. So we took a look at the Dow Jones Transportation Average. That's this chart right here that was actually making higher highs as the market was making lower lows here. So we had this flash crash here during the month of April, And if you took a look at the Dow Jones Transportation Average, you can see it wasn't following up on that crash. Now, if you're not aware of Dow Theory, it tells you that the transportation average should always move with the market. And if it doesn't move with the market, it tells you there's something wrong. And you can see Dow Theory helped you time this top here with these higher highs in the S&P 500 during November, December, and January, and yet the transportation average was going down. But you can see now we have another type of divergence where we have lower lows on the S&P 500, but the transportation average is actually making higher lows. S&P 500 going down, transportation going up. That's divergence. And by the way, this is really what the website is all about. All of these indicators, these developments that we're constantly watching, we really have a passion for the market. We have a passion for understanding where it's going. And we created this website so that we can do the work for you. You know, everyone wants to manage their own money, and that's absolutely fantastic. But if you don't know what you're doing in the market, you can get absolutely wrecked, and very, very quickly. So that's why we use these sorts of tools, why we're actively looking at the research, so that you can actually have an edge in this crazy market and not jump in right at the top or panic sell right at the bottom when a lot of indicators are telling you that you shouldn't be doing that. And we do this through the frequent articles that we post that highlight all the important levels, developments, and indicators that we're currently looking at. We have a ratings dashboard that takes a look at the short, intermediate, and longer term outlooks with all the reasoning explained for all the assets that we like to look at. And of course, the trading watch list that highlights the key opportunities that we're currently looking at. So if you're interested in participating in that journey with us, make sure to click on the link down below. So back to that chart of the S&P 500 against that transportation average, we talked about the divergence with the S&P 500 making lower lows and the transportation average just not following the same pattern, right? Let me just make that a little bit more clear for you guys. Look at this just in the short term between the 8th of April 2022 and the 6th of May 2022. We have clear divergence between the S&P 500 and the transportation average. If we jump to that chart of the S&P 500 right here, as the S&P 500 was testing that neckline support right here, look at what was happening to the transportation average. It was tanking down here. This is not at all the same look that we have today. Transportation here was telling you that the market was going to break down. It was going to break down to lower lows. In fact, right here, look at what happened on this move here. You had a lower low and then a higher low on the Dow on that transportation average. That was telling you that this was going to be a bottom. In fact, it led to a 3-month rally on the S&P 500. Now, that may not sound like much, but that's 3 months of the S&P 500 rallying is enough to completely change investor psychology, especially with a 14% rally. Now, I hope you guys enjoyed this episode. If you did, make sure to click on that like button and subscribe if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.